Berkshire Hathaway recently had their shareholder meeting where shareholders heard from Warren Buffett about the company and about the economy. And in today's episode, we're going to talk about lessons learned from what Warren Buffett said. And in today's show, relate these lessons to us and whether we're in a good economy or in an economic downturn, how to utilize these lessons and this advice to help keep us on track towards long-term financial success.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome back to another episode of the Your Life, Your Money podcast, where we're here to help and discuss thoughts, strategies, and actions to help you thrive in life, wealth, and retirement. I'm your host, Scott Searins, and in today's show, we're going to talk about 6 lessons from the Oracle of Omaha, Warren Buffett, and what he said at the recent Berkshire Hathaway annual meeting. Some key takeaways from today's episode is whether it's a good economy or a bad economy, it's the same advice that helps keep us on track towards long-term financial and investing success. Warren was not born a billionaire. He did not inherit billions of dollars. He has amassed his wealth over a long period of time following a straightforward process. And so whether you have $500,000, $1 million, $2 million, or more, we're going to talk about how we take his advice and relate it to our own picture. And again, put it to use towards long-term financial and investing to help us towards that long-term financial and investing success. Before we dive into the article and the lessons learned, we continue to help a lot of folks out with tax strategies and tax planning to help them reduce their long-term tax picture. And if that's something that's on your mind, I challenge you to go to lifemoneyshow.com. Again, that's lifemoneyshow.com. And check out our video, 3 tax strategies for savers and investors. You'll find these strategies helpful for you and helpful in regards to how to reduce your overall long-term tax picture. Now, let's get into today's article. So today's article and what I want to go through, these 6 lessons from what Buffett said at the Berkshire Hathaway annual meeting. This article is by Bankrate.com. And I want to break down this article. I want to talk about the 6 lessons, but more importantly, I want to take and say, how do these relate to us? Because I know one of your thoughts might be, Warren Buffett, gosh, this guy's got billions of dollars. How could this possibly relate to me? He's got way more money than what we have. But folks, there are some really good takeaways. I will say this. First and foremost, right? It talks about Warren Buffett being 91 years old. When I see his age, here's what I think. There is lots of experience to learn from here. He's seen plenty of corrections. He's seen lots of recessions. He's seen lots of bull markets. So this person, Warren Buffett, whether he's got billions of dollars or not, he's got billions of dollars because of the processes that he's taken, the lessons that he's learned over a long period of time. So what can we take away from his experience? Berkshire Hathaway's business touches many different areas of the economy, including insurance, retail, manufacturing, energy, and more. It talks about how, Warren has stakes or ownership in Geico, Dairy Queen, Apple, Bank of America, Coca-Cola. So Warren is very diversified. He is an investor just like us. And so I think it's important to look at the lessons here, look at the advice, and realize he keeps it really simple. It relates to all of us, whether we've got $500,000, whether we've got $750,000, whether we've got millions of dollars, or even more than that. The lessons here, the advice in the article, and as I'll take that advice and then relate it to us in our picture, it's simple, it's actionable, and it is very similar to the approach that I take with clients as well once we break it down and relate it to us. So let's jump in. 6 best lessons. Again, this article is from Bankrate.com. You can go to lifemoneyshow.com. Again, that's lifemoneyshow.com and click on the show notes. I will have a link to the article if you want to go through and read the entire article yourself. What this is from is Berkshire Hathaway had their recent shareholder meeting, and these are 6 lessons from what Warren Buffett said at that Berkshire Hathaway annual meeting. Here we go. Number 1, make sure your portfolio is built to survive. Berkshire Hathaway is known for holding large amounts of cash on its balance sheet. In the article here, it says Warren Buffett highlighted the importance of holding enough cash to ensure the company can always survive, especially during market panics similar to the financial crisis of 2007 through 2009. I thought these were awesome quotes, and then we're going to break this down on how this relates to us. Warren Buffett said, "We will always have a lot of cash on hand. There have been a few times in history, and there will be more times in history, where if you don't have it, you don't get to play the next day." He added, "It's like oxygen. It's there all the time, but if it disappears for a few minutes, it's over." Think about that one more time when it comes to cash, and we're going to think about this and relate it to our picture. It's like oxygen. It's there all the time, but if it disappears for a few minutes, it's all over. How does this relate to us? This simple advice here. Folks, as we continue to talk, it's always important to have cash on hand. You could call that a rainy day fund. You could call that your reserve. You might call it your emergency fund. But do you have cash on hand? Some good rules of thumb would be 3 months of expenses, 6 months of expenses. Maybe if you own your own business, you're looking at a year of expenses or more. And you know what I've found is that when people do have cash on hand, it just provides them peace of mind because of what Warren Buffett was talking about, right? During market panics, similar to 2007 through 2009, having that cash on hand, if there was to be another recession, if you were to lose your job, it gives you a safety net to rely on as you find another job. If you're already retired, we're going to talk about that. We're going to talk about your war chest. It gives you that safety net to rely on while the market or the growth side of your portfolio rebounds. Have you ever heard of Murphy's Law, right? Murphy's Law is that like when one thing goes wrong, then it's almost like Murphy keeps knocking on the door and things continue to go wrong. Here's what I've found, is that when you have cash on hand, it's kind of like Murphy doesn't come knocking on the door. For instance, let's just say you've got, and I'm just making up a number, $50,000 of cash. And let's just say with 2 people, right? One's got $50,000 of cash and one's got $1,000 of cash. Well, let's just say then the car breaks down and it's a $2,500 bill. The person with $50,000 of cash does not feel like this is an emergency because they've saved up for it. They're going to use part of their $50,000. They'll probably replenish it over time. And you know what? The fact of Murphy's Law kind of just doesn't even exist and goes away because it doesn't feel like an emergency. It doesn't feel like everything's going wrong. But for the person who's only got $1,000 saved up and then this $2,500 bill comes, one, they're short. And so now that becomes stress. It feels like an emergency. How are you going to pay the bill? Where's this money going to come from? And then you're trying to pay that down. And then the next thing comes, and that feels like an even more emergency. And it's Murphy keeps coming knocking on the door. Folks, having cash on hand keeps Murphy and Murphy's Law from knocking on your door. The other thing is for those that are approaching retirement or in retirement, similar to what Warren Buffett is saying here, having that cash on hand is like having your war chest in place, a pool of funds not subject to the same volatility as stocks. So that way, right, it's not if, it's when we have that next downturn in the market, similar to 2007, 2009, similar to 2020, and what we're seeing actually in the market today. Having that war chest in place, that pool of funds not subject to volatility, allows you to survive those downturns, those corrections, those recessions. It gives you a pool of funds to go to withdraw from, to do all of the things that you need to do to live your lifestyle, go on vacation, all of those things that you've planned, while the growth side of your portfolio rebounds and comes back up. So while everybody else is panicking, you're prepared, and you're looking at them panicking, going, what's going on? You've got your war chest in place. You're going to go ahead and book your next trip, book your next vacation, and continue to live your lifestyle and not go through the same panic as everybody else. Moving on. Lesson number 2, Warren Buffett said, focus on value, not on timing the market. So in the article here, it goes to say Buffett reminded shareholders that he never knows what the stock market is going to do in the short term, which is why attempting to time the market is a poor investment strategy. Warren Buffett himself said, we have not been good at timing. We've been reasonably good at figuring out when we're getting enough for our money. And the article went on to say Buffett pointed out that they were too early in deploying funds in 2008 financial crisis, and said that he totally missed the opportunity in March of 2020. So how does this relate to us? Well, if a billionaire, Warren Buffett, doesn't know what the market will do in the short term, and if he himself was missing opportunities in 2008 and 2020, how could we, if I'm going to call us the average investors, how could the average investors know how to time the market? Folks, it's a fool's game. You have to make 2 right decisions. You have to make that right decision of when to get out, and also that right decision of when to get back in. And so timing the market is not a strategy. And as a matter of fact, a lot of some of the biggest up days in the market tend to happen during the biggest downturns of the market. So missing those days could potentially ruin your long-term results. Key point and takeaway from what I read in the article in this part, and that relates to us, and I'm going to really emphasize it here. He said that he never knows what the stock market is going to do in the short term. Very key takeaway there. Never know what it's going to do in the short term, but he does have an idea from a long-term standpoint. And this is why we constantly talk about taking a long-term approach. Taking a long-term approach to investing, to the stock market, to putting your money in the market. Again, back to lesson number 1, if it's short-term money, if you're going to need it in the next 1 to 3 to 5 years, well, we should be keeping that in the war chest or in cash. However, if it's going to be longer term than that, well, we have to have a long-term thought process, meaning Warren Buffett said he doesn't know what the market's going to do in the short term. Could go up, could go down. That's just the history of the market and the volatility of owning stocks and bonds. But what we have seen is that over a longer period of time, the market eliminates the downsides, could potentially eliminate the downsides, right? And that we've seen over a long period of time, history has shown us that the market has provided a positive return. So, lesson number 2, we're not focusing on trying to time the market. When do we get in? When do we get out? Are we getting in at the right time or not? We're focusing on a long-term plan, putting money at growth for our future, having our war chest for our short-term needs. Here we go. Lesson number 3 that the article stated here was owning productive assets is the way to go. I thought this was really interesting. I mentioned at in the beginning of the podcast, right? This man is a billionaire, but he keeps it so simple and actionable, and this is the exact process and approach that we use with our clients as well. The article talks about here, Buffett made his preference clear, is where he likes to put his money. Assets that produce value for their owners. There are many investments that fall into this category, including stocks, bonds, real estate properties, farmland, and then it said, and more. What does this mean? Well, let's just kind of bring it into a couple examples. Let's say, he said real estate properties, right? Owning an apartment building or owning a REIT, real estate investment trust fund, right? By owning an apartment building, you have renters that pay you income. So this is a productive asset. You own something based on what you own. You're selling I'll say, for lack of better terms, you're selling out apartments, and because you're providing a product, an apartment, a place for somebody to live, they are providing you or paying you income. I'm just going to use Warren Buffett as an example, right? He's got a heavy stake in Coca-Cola. Every time somebody buys a Coke, whether it's at a gas station, a grocery store, a restaurant, Coke makes money for selling that product, and then he's getting part of the profit. So if you're an owner, a stakeholder in Coke, again, every time a Coke is sold, you're getting profits from those sales. It's just keeping it simple. Do you own productive assets? So how does this relate to us? Well, when creating an investment portfolio, are your investments productive assets? Do they produce something that can be sold to generate profits? And then, are your investments diverse? Do they cover multiple asset classes? Do they cover multiple asset categories? Going back to Warren Buffett and kind of some of where he puts his money and the Berkshire Hathaway owns, or areas where he has significant stakes in. We've got Apple, that's technology. Bank of America, that's financials. Coca-Cola, Geico, that's insurance. Dairy Queen, right? Restaurants. So he's got a diverse holding because as some assets or some of these businesses will be doing better in some types of economies, others might be not doing so well. But then as we go through the economic cycle, some of these will be doing better as the economies shift, while those others might not be producing as much. So wrapping up on that, having an investment portfolio of productive assets, investments where what you're investing in produces something that can be sold to generate profits and generate growth. All right, our next lesson here is avoiding the speculative nature of the stock market. I like this. I'm going to just read right from the article, and it's a quote. It says, "It's a gambling parlor," Buffett told shareholders, adding that Wall Street had contributed to the casino mentality. Quoting again, it says, "They don't make money unless people do things. And they make a lot more money when people are gambling than when they're actually investing." So how does this relate to us? First off, when you look at your investment portfolio, are you taking a speculative approach, or do you have a diverse portfolio? Here's what I mean. Here's somebody that might be taking a speculative approach. You've got too much of your overall portfolio in one stock. What's a good rule of thumb? If you've got more than 10% of your overall portfolio concentrated in one stock, that's too much as a general rule of thumb. And so you want to diversify that particular holding. Or are you chasing stocks because they had, keyword there, had, not have, because they had high returns? Remember, past performance is not indicative of future results. So here's a really good example. Think about what happened in 2020, right? The pandemic. We all have to stay home. Well, what did people start subscribing to? They start subscribing to services like Netflix. Well, Netflix had growth in the market. Now, you can go to Yahoo Finance and run the different charts. I did this for Netflix. And in 2021, so last year, Netflix had around 11% growth. So let's just say you're like, boy, that stock's growing. I'm going to, because it had, not has, had growth, right? I'm going to start putting a bunch of money in there because I think that that's growing, and I'm going to put way more than 10% of my overall portfolio into Netflix. Well, folks, so far in 2022, and I ran again in Yahoo Finance, and I ran this through the end of April, Netflix was down around 68% through the end of April. So taking a speculative approach, you could potentially have some really, really good gains, but you also could potentially really, really underperform the overall market. Or you could have a diverse portfolio. like I had mentioned earlier, think about Warren Buffett. He's not just holding one company. He's got cash. He's got stake in Coca-Cola. He's got stake in Apple. He's got ownership in Geico, Bank of America, which is financials. Geico was insurance. Apple was technology. A diversified approach. We do the same when working with our clients. We've got a diversified approach. We've got large cap stocks, meaning large companies in multiple sectors like technology, like insurance, like financials, like retail. Mid cap stocks, middle-sized companies, small cap stocks, small-sized companies in all of those different sectors, as well as international companies, companies in developing markets. And then if we're in the bond or in the war chest side, right, we might have some cash, we might have some bond funds, and those bond funds might be in treasuries, it might be in mortgage-backed securities, might be corporate bonds, might be government bonds. Folks, taking a speculative approach, while you might maybe outperform the market, there is also a really high chance that you could also potentially drastically underperform the market. I realize sometimes it's tough because everybody else out there is going, boy, I just put money in XYZ company. It's doing great. It went really, really well. But they also might be right now seeing and probably not bragging, right, if what's happening to them is what's happening to Netflix. And that diversified approach, while it may seem boring, it's what helped and has helped Warren Buffett amass his fortunes. All right, our final lesson here to discuss is your skills can't be taken away by inflation. Now, I thought this was really interesting, right? Because this wasn't necessarily focused on investing, but, a big question on all of our minds is inflation. And Warren Buffett, I'm going to read from the article here. It says, the best thing that you can do is to be exceptionally good at something, Buffett said, because whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. So having a focus, having a concentration, as inflation goes up, part of your way to keep up with inflation or to keep up in the job market and to continue to raise your wages is to have and be exceptionally good at something. So that's really something that relates to us that are still working. But let's just say you're retired. I realize that this advice may not help the person that's retired or 1 year away or 2 years away from retirement. So I wanted to just kind of add my own little lesson here, and this goes back to things that we've talked about in previous podcasts, but I think it relates to all of his points, right? So the final lesson is kind of wrapping all of this together. If you want to keep up with inflation, you've got money out there growing for you. You've got to have it on the equity side of your portfolio. We need to be a stockholder, a shareholder, having money growing for us to keep up with inflation. But at the same time, and wrapping all this together is, do you have a portfolio that's built to survive, right? Do you have cash for those short-term needs? Do you have your war chest to help support you in the event of an economic downturn or recession? Do you own productive assets? Are you a stockholder in companies that are producing goods and services that can be sold, and profits from what is being sold can be transferred to you so that you can continue to grow your value and your stakeholdership in that company? And then, are you avoiding speculation and timing and not letting short-term perspective ruin your long-term results? Folks, I thought those were there was a lot of great lessons in the article, and I hope that I've helped you take those lessons and relate them to you and where you're at in your life, whether you're 5 years away from retirement, whether you're still working, or whether you're retired. Taking those lessons, relating to them to us, again, it's this simple advice that keeps us on track, whether we're in a good economy or a bad economy. And even though we can look at this man, Warren Buffett, and go, wow, this guy is worth billions of dollars, it's knowing that that didn't happen in a day, he didn't inherit it, and that it was a process that took a long period of time to build up to. And it was this simple and actionable advice, these strategies that we continuously utilize with our clients as well, that helped keep him on track and helped him grow his wealth over time. Folks, I really hope that you found today's episode of value and benefit. And if so, subscribe on your favorite podcast player. That way you get notified as we're continuously coming out with additional episodes that will help you build long-term wealth, reduce your long-term tax picture, and help you in improving your overall financial situation. Again, check us out on lifemoneyshow.com if you want to read the article in full, see the notes from today's episode, lifemoneyshow.com. That's lifemoneyshow.com. And don't forget, go there and check out the video, 3 tax strategies for savers and investors. I really look forward to our next conversation to continue to help you build wealth, live life today, and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.